By the end of this video, you are going to learn about one of the most important numbers in the investing process. Not P to E ratio, not P to B ratio, it's debt to equity. Here's how we're going to do it in 3 steps. Number 1, what is the debt to equity ratio? What is the formula? What does it tell you? Number 2, why it's so important, using industry context to help you and helping you look at any red flags. And number 3, how I get my data. So kind of the steps I use to get my data. Got some real examples in there for you too. If you check only one number before buying a stock, this could be the one. This is the most important one if you ask me. Quick disclaimer before we start, I've said this in all my videos, I am not a financial advisor, I'm a teacher, this is my opinion, this is what I do for fun, this is a hobby, this is not advice. These are my opinions and my personal strategy, so do your research before you buy anything. Let's get into it, let's do it. In my value investing video, I talked about Benjamin Graham. I mentioned debt to equity ratio as one of the numbers that I make sure I check. Today, I'm gonna do a deep dive on just that one number. Why? Because debt is how companies die. A company can have great earnings, great assets, great management, but it's got a huge amount of debt, it's in a bit of a pickle. Debt to equity tells us how much a company has in debt versus what the owners have put in. It's a safety check, small one, just like a red flag detector. Let me show you how it works. Right, the formula is incredibly simple. Total liabilities, so that's everything the company owes, loans, any bonds, any leases, anything at all. You take that and the shareholder equity, which is what's left again if you sold everything off. Divide the debt by the equity. That is your ratio. Debt to equity, D to E of under 0.5, low debt, very safe, conservative company. Between 0.5 and 1, it's a reasonable debt, it's pretty normal actually. D to E of between 1 and 1.5, that's normal, but it's getting pretty high. We kind of want to understand why. D to E of over 1.5, that's high debt, that's a bit of a red flag. Proceed with caution there. A D to E of over 2, that's really unusual and usually a no from me, unless there's like a really special reason for it. But look, here's the thing, you can't just look at these numbers on their own. Different industries have different ranges. Utilities and REITs, or REITs, they have naturally high debt. That's their business model. Tech companies, usually low debt. High debt here is a big warning. Banks and financial companies, that's a different calculation entirely. You can't compare apples and oranges here. That's why I compare against like industry peers, not just why is this number good. You compare it against the peers in the marketplace. Right, do me a comment below, because I'm all about the learning community here. Do you currently check the debt to equity ratio before buying a stock? Give me yes, give me a no, give me a red flag number if you do. Right, part 2. Why is debt to equity ratio so important? Right, here is the brutal truth. Excellent, profitable companies go bankrupt all the time. Not because they couldn't make money, but just because they couldn't pay their bills, they couldn't pay their debt. When interest rates rise, debt gets more expensive to service. When revenue falls, debt payments are going to stay the same. If revenue falls, the debt payments are going to remain the same. When lenders get a bit nervous about this, they're going to call in the loans or not refinance. A company with low debt can survive the bad years. A company with high debt, one bad year can kill it. Now, Peter Lynch, one of the greatest investors of all time, if you don't know who he is. He ran Fidelity's Magellan Fund and averaged about 29%. Here's what he said. Companies that have no debt can't go bankrupt. And he told a really good story about this. He was looking at a company called Kaiser Industries. That stock had crashed down from $25 down to $4. But the company had no debt. So Lynch said, oh, I wasn't worried about it going bankrupt. He actually told his own mother to buy it. She didn't listen, and maybe that was a good thing actually, because it dropped even further. But his point was, it was the debt, not the risk. That's the power of low debt. This company, it recovered, stock price recovered, but because it had no debt, it could survive. It didn't matter. Like, no lenders were knocking on their doors demanding repayment. Right, and I don't just look at the absolute numbers. I look at the peer average. So I compare one company to other companies in the same space. I find the average debt to equity for oil and gas companies, for example. Let me give you an example. Let's say we're looking at oil and gas companies. I find the average debt to equity ratio for oil and gas companies around 0.8. The company I'm looking at has a D to E of 0. That's great, it's below average. The company has a D to E of 1.2, that's above, and I'm going to be looking at why. And if the company has a D to E of 2.5 or more, that's probably going to be a no from me. but I'm quite good at breaking my own rules, so I'd have a look at why. Now, REITs or REITs are different. Real estate investment trusts use debt as part of their business model. They borrow to buy properties, that's how they grow. A REIT with a D2E of 1.5 or 2 might be perfectly normal. Same with utilities. They have a stable cash flow and can handle the higher debt. That's why context matters. You can't compare a REIT to a tech company. You compare REITs to other REIT, that works. Bottom line here, low debt doesn't mean it's a good investment. It doesn't guarantee it's a good investment, but high debt is definitely a warning sign. And ignoring debt is how beginners lose money. Check debt to equity before every purchase. Compare to peers and kind of get yourself an understanding of the industry context before you decide. Right, I've got a challenge for you. Go and look up a debt to equity ratio of a company that you own and comment it, and then we'll have a quick discussion about it. I'm gonna reply to you with whether I think it's safe or whether I think it's risky. Right, let's get to the, let's crunch the numbers now. This is how I get my numbers. Simple, but conservative, in my opinion. Now, the first thing I do, I type in the company debt to equity ratio into Google. Right, we're gonna try and do a bit of screen recording now. Let's give it a whirl. Right, we're going to do a bit of screen recording now. So we're recording. So I've got Google open here. We're going to go for a, what company can we go for? What have I been talking a lot about recently? You know what, let's go for Burberry. That's a stock which I quite liked. And I did make a reasonable amount of money on it last year as a speculation play. So let's have a look. We've got a Burberry I type in the Burberry D2E ratio and it's I'm going to ignore the AI and go down to look at some of these numbers. I'm just going to use the numbers from Google, or what pops up. So I've got 1.73, I've got 60%, which is 0.6, which is again a no. You might see this sometimes where it has a percentage, that's 0 point something. 100% is 1. Think of it like that. I'm going to open up Yahoo here. On the LSE, there's no D2E ratio here. I've got 1.9 here for good. Though I think 1.9 was the highest number I saw, so I'm going to take 1.9 from there. Second step, open up Yahoo, because Yahoo is it's quite easy for me to find. It's free. Let's go down and look at the D2E. Let me search it. D2E ratio, debt to equity. Yeah, there we go. So total debt to equity, 172%, which is 1.7. So that's just how you convert it, 172%. 100% is 1. That's the way to think about it. My teacher hat on. So we've got 1.7. 1.9 was the highest number, so I'm going to take 9 as my number. And then we're going to compare it to industry peers. So let's go back to Google. You know, I don't even know what I call this sector. Is it fashion average D2E ratio? So it's going to pop up here between 1 and 1.2 according to the AI here, Google's AI. I'm probably going to say then we're going to find out why. Why is it high? If there's a good reason, fantastic. If there isn't, if it's a declining industry, we're going to look at why. Okay, so that's the way I look. Right, let's stop the recording. Hold on, guys. Perfect. We're back. Bam, bam. Right, now here's my rule. Different platforms will show different numbers. There's reasons for that. Stock price changes. There's all different reporting things that could be different. You could just have a look in the actual balance sheet, but that takes more time than I'm going to look at for here. So this is my more at a glance approach. I'm going to take the highest number from the last couple of years. Why? Better safe than sorry, in my opinion. I'm just going to go crazy and assume the debt is actually higher than it is, because there might have been a smart accounting trick there as well to bring it down. If I did the opposite and assumed the debt is lower than it is, yeah, that's dangerous territory there. One more thing that drives me crazy, most brokers don't show the D2E ratio on their fundamentals. How annoying is that? They'll show you the P2E ratio, they'll show you the P2B ratio, they'll show you the dividend yield, but they don't show the D2E, which arguably is the most important one. I'm not sure why it is. Maybe it's hard to calculate. Maybe we don't actually know. There's many reasons, I'm sure. In any case, it's annoying because you have to go and look it up yourself. Anyway, Google, Yahoo Finance, looking at the company's filings, it only takes a couple of minutes to find an appropriate number. But those 2 minutes are going to save you from buying a company that's drowning in debt. Don't be lazy about this one. I'm telling you, don't be lazy. The way I like to do it is if it's below the average, goes on the watch list. I'm not going to buy it there and then or whatever. If I'm doing my stock research, I'll say if it's below the industry average, stick it on your watch list. It's definitely one to watch. And then using my £100 method, maybe that could be a good one for the next £100. But it definitely goes on the watch list for a closer watch. Right, let's do some commenting now. What do you use? Do you check debt to equity? Maybe you don't even bother. Do you have a specific screener, or do you just use Google? Actually, Yahoo Finance is a really good free screener that you can use when you log in. Let's comment your method. Let's share what works. Again, I'm learning too. This is all about learning. Right, I'm going to quiz you again. Teacher style. What's the formula for debt to equity ratio? If you said total liabilities divided by total shareholder equity, you were right. Who said that companies that have no debt can't go bankrupt? Yeah, Peter Lynch. Yeah, well done. Very good. I'm just name dropping now, aren't I? And number 3, when I'm looking at across different platforms to get my information for debt to equity ratio, which number do I take? Yeah, if you're shouting at the screen, the highest number, you're right. Take the highest number. That's what I do. I just like to play it safe. Right, if you haven't watched my first 6 videos, go and have a look. I'm trying my hardest. I mean, it is quite a nice hobby, this YouTube thing, and I'm enjoying it so far. We'll see what happens. Go and look at my other videos, go and add some comments. Let's engage as a community, because I really enjoy this stuff and I want to meet like-minded people who enjoy it as well. So that's kind of my vision for what's going on with this channel. Again, my first video is the foundation for all my stock picks. So if there's anything, go and watch that. Thanks for watching, and remember, check the debt to equity ratio before you buy. And I'll see you in the next one.